One of the biggest lies I hear lenders, realtors, and investors tell people: buy a home, it's a tax deduction. Buy a home, you'll save more money. That's actually not correct. What's going on, guys? My name is Minh with What's a Mortgage. Welcome to our channel. The goal of our channel is to simplify home ownership. And today, I want to tell you guys the truth about getting a mortgage. Is it tax deductible? It can be, but there's a chance it cannot be tax deductible. So tonight we're going to go over filing tax returns as a homeowner in 2021. So if you're not a homeowner and you will be one day, how to make sure your mortgage interest is tax deductible. If you already own a home, how do you make sure your mortgage interest becomes tax deductible? All right, if it's your first time tuning in, do me a huge favor. Please hit the subscribe and notification button so you're notified every time we go live or post new content. We go live every Monday night on Facebook and YouTube at 9 p.m. And we go live on Instagram on Tuesday at 9 p.m. And I do post content daily on Instagram and TikTok every day. So please go ahead and follow our other channels as well. Remember, this is an interactive live stream, so ask a lot of questions. But before I go into taxes, I am not a tax preparer. I'm not a CPA. I'm studying to get my CTEC, but today is just advice that I got from reading the IRS website. So please go ahead and verify all this information with your tax person or with your CPA, or verify with the IRS. This is just me reading from the IRS guide. Okay, guys, let's get into it. So you already bought a home or you're about to buy a home. Guess what? Mortgage interest might not be tax deductible, but people keep telling everybody, these professionals are saying mortgages help you keep more of your income. Why is that? Because of your deductions. First of all, this is one subject they should have taught us in school. Before you graduated high school, they should have taught us about the standard deduction and the line itemization. Look at the standard deduction. So when you go out there and get a job, you will pay taxes. I wish they would have told us about taxes before we picked our career, because after taxes, then there is your net income. You should have known that, and it helps you make the better decision for yourself down the road. Don't you wish in career day they would have told you the gross income, or you can Google the occupation and you look up the income and you see what state you're in, so you know if you pay state income tax or not, and decide should you take that job. Also, should you buy that home? If you do buy that home, are you buying it for a tax deduction, or are you buying it to gain equity? Just know that when you do file taxes one day, you enter the workforce, you're gonna either file as a single person, married file joint, married file separate, or head of household. So whatever your income is, there's something called a standard deduction. So take your income minus deduction, and then they tax you, which we'll go over in a second, called the income tax bracket, which they for sure should have taught us back in high school. But what does mortgages do? Mortgages help you with something called line itemization. So when you do claim deductions, you can take either something called a standard deduction or the itemized deduction. So of course, if you don't own a home and you're a wage earner, you typically will take the standard deduction. If you do own a home, you want to make sure your mortgage interest and your property taxes and your PMI and your origination points are above the standard deduction. Because if it's not above the standard deduction, then what's the use of the mortgage? That's why if you get a home, California, Florida, in the higher income areas, it is easy to hit the line itemization when you get a mortgage, because mortgages are so, the loan amounts are so big. But in the lower purchase prices or the lower loan amount, or they say, oh, you own a home, you're home free and clear, why don't you get an equity line of credit? If you get an equity line of credit and the loan amount's not big enough, you're still going to take the standard deduction, so it doesn't matter. Make sense? So be careful that when you get a home, make sure that, hey, is your mortgage interest and the rest of your line itemization greater than the standard deduction? If it's not, most likely all that effort of getting the home might not give you the line itemized deduction. Doesn't mean you shouldn't get a home, but when you get a home, you should know, hey, I'm going to get the itemized deduction, which is greater than the standard deduction. Or, hey, I'm not going to get that, but I'm going to get more appreciation. Look at single person, $12,500. So you think about, if you had a mortgage and you were a single person, the standard deduction is $12,500. So there's a higher chance you're going to get the itemized deduction compared to married. Married is $25,100. We'll break it down so you understand a little bit better. Let's get back into itemized deduction. What you want to do is, just January 2022, you want to get something from your lender called the 1098. It will show you how much interest you've paid on your mortgage that year. And you want to add up your property tax. If you have PMI, your PMI is tax deductible. If you make under $100,000 to $109,000 a year, PMI is tax deductible. But it might end after 2021 if they don't renew it. They said they were going to renew it in 2020 for 2021, but they did. So in 2020, 2021, PMI is tax deductible. And of course, if you paid any origination points, or you amortizing your origination point, all of that is tax deductible. You want to total all of that, plus you want to total your any donations. Also, if you have medical expenses, how your medical expense works, it's whatever is above 7.5% of your adjusted gross income. For example, if you make $100,000 a year, that's your adjustable gross income. Anything above $7,500 is tax deductible. So you want to make sure you add your charitable donations, your medical expenses, and then your mortgage, everything that goes on with your mortgage, your interest, your property taxes, your PMI, your origination. And of course, if there's not enough, you can max at $10,000 on your property taxes. If you don't hit the $10,000 in property taxes, you could use your estate taxes that you pay. The total is about $25,000. So if you combine it together, you want it to be greater than $25,100 for married and $12,500 for single. Of course, married files separate's different, head of household filing separate. But the other common ones are single and married file joint. Okay, so you want to make sure you total all your itemized together, and is it greater? And this is how it works with your deductions. So typically, there's 7 income tax brackets. This is before state, and then there's FICA and Social Security, right? There's 10%, 12%, it's 22%, 24%, 32, 35, and 37. You'll fall under one of these tax brackets. For example, if you make $100,000 a year, of course, if you were able to deduct $25,000, you're only going to pay tax on $75,000. The greater you can increase your deduction, the less you pay tax on. Even though you made $100,000, if you take the standard deduction, you're only paying tax on $75,000. But imagine with your mortgage, and you can surpass the standard deduction. That means you pay tax on the lesser dollar amount. Here we go for married couple. It's a little bit higher for married, right? The numbers are the same, but look at the percentage here. Think about married couple. If you make $172,000 and you're in the 24% tax bracket, you're able to subtract $25,000 from that. You pay no taxes on that $25,000, and you would be in the lower tax bracket, in the 20%. No matter how much you make, the deductions allow you to pay taxes on the lesser of the dollar amount. So that's why you want to make sure you focus your energy on surpassing the standard deductions. So that's why they should have taught us back in high school, right? Before we entered into the job world, what tax bracket am I in? Understanding the standard deduction and the line itemization deduction. How do you find a way to get into line itemization? In the standard, you're just going to get the basic standard deduction. But if you can find a way, and mortgage interest does help, and I'll go over that one second, okay? Mortgage interest does help. But you'll see, the more you deduct, the less you pay tax. Here's an example. Let's say you make $100,000 a year, and the standard deduction is $25,100. In California, with FICA and Social Security, you would take home your net $80,000. Your net home $80,000. But let's say you were able to write off more interest, and you were able to surpass the standard deduction. Look at $30,000. At $30,000, you get almost an extra $3,000 take home. So if you were able to go past with your mortgage interest, with your property taxes, with your PMI, with your medical expenses, with your charitable goods, you're able to get the $30,000. There's an extra $3,000 back. Imagine $40,000. $84,000, you would get to keep an extra $4,000 on your income. That's why it's important to understand how these deductions work and how to get from standard to line itemization. I'll talk about married because those are the most common people that buy a home. Of course, single, to pass the standard deduction of $12,500 would be easy with a mortgage, would be easy with your property taxes. You get $10,000 in SALT, state and local taxes already. Think about with your SALT, with your medical, if you pay any insurance premium out of pocket, if your company pays for it, you can't count that. Whatever you pay out of pocket, plus the SALT, you're already passing that as a single person. But as a married person, it's hard. If your mortgage was $400,000, okay? Also, another thing I'll go over in a second, you cannot write off any interest above $750. It has to be under $750. Okay, look at $400,000 right here at a rate of 3.25%. You guys see that right here? $12,881. That's all the interest you have year one on a $400,000 loan. Of course, if it's deeper in the years, you get less. You get less. That's why I put out 400,000. Think about if the SALT, the state and local taxes at 10,000. So if you were year one at 400,000, you would have a 22,881. You would need almost 3 grand more in medical expenses. Of course, if you pay 2 grand a month for medical insurance, then anything past the 7.5% of your adjusted gross income, you can deduct. That's why under 400 grand would be really hard as a married couple. Single, you're at 12,500. So you're already in the line itemization. So that's why I tell people all the time, you know what? Mortgage interest can be tax deductible, but it's not always. Everyone who's telling you, ooh, buy a home, mortgage interest is tax deductible. It's not always. And I'd rather tell you the truth. When you buy a home, you should look for tax deduction, but you should also look for appreciation, locking in a fixed payment. If someone's going to tell you the truth about mortgage, they should tell you the truth about the deductions as well. Some people don't even know that. So if you're out there and your mortgage is under 400 in the 3s and 2s and 1s, nationwide, yes, there are ones. I know some of you guys are like, oh, there's no one. But even if you get a line of credit over 200 grand and you max it out, you might not pass the standard deductions. So you might just take it. So yes, if you have a mortgage above the standard deduction, it's good. If it's under, you're not really going to get to deduct it unless you use that money to invest it and you write off the interest against your business. That's a completely different ballgame. So that's how you use your mortgage to pay less taxes, to keep more of your money. It's all about getting your deductions from standard to line itemization. Your 3 main deductions: property taxes. So when you get your 1098 and when you look at all your documents, look at your property taxes. Remember, 10,000. If you don't have 10,000 in property taxes, I'm sure you can add your state taxes that you're paying to be at 10,000. So the 10,000 is almost a given. Mortgage interest. You're going to get that 1098 form from your servicer. If you haven't got it yet, you will get it by the end of the month. Make sure you have all this stuff for your lender. The greater the balance, the higher the rate, the more you're going to deduct. Except for you cannot go above 750. Only on primary residence. Also, PMI, very huge deduction. If you make between 100 to 109, you can deduct it. Also, with your deductions, if you bought a home, you have other deductions. But these are your standard deductions. When you talk to your tax person, you want to make sure you have all this paperwork so you can maximize your deduction. Remember, the goal is from standard deduction to line itemization. Increase those deductions. Pay less taxes. But if you have all that information in front of you, it's so easy to file. So grab your 1098, get your tax records. Also, get a copy of how much you paid in PMI. Also, if you bought your home in 2021, here's the other deductions to put you in line itemization. If you bought a home, if you paid an origination point, a discount point, all tax deductible on owner occupied. Down payment assistance. If you got a down payment assistance loan, even though you financed the origination or discount point, it's tax deductible. If you finance it, you might not be able to write it all off at one time. They might amortize it. They might stretch it out. I think for about 7 years from what I saw. But definitely talk to a tax person. So if you finance it, you can amortize it. You can still deduct it. If you bought down the rate, either you came out of pocket, you finance it on a refinance, all tax deductible. You have an FHA loan or VA loan, you have upfront PMI, VA funding fee, all tax deductible. You have a VA loan, you have the guarantee fee, all tax deductible. So you bought a home, you want to grab something called the final HUD, which is the final receipt or your closing disclosure, which shows how much you paid in origination, in discount. If you did down payment assistance, if you bought down the rate, you did a loan that had upfront PMI or VA funding fee or the guarantee rate, it's all tax deductible. Guys, leave me a comment below. Don't you wish they taught you this in high school? I forgot to start interacting. Guys, you find this information valuable, do me a huge favor. Please save this video, share this video, and like this video. If you're a school teacher out there, hey, ask your school, can Minh come and teach this course? I wish this was a course they taught us in high school. If you found this valuable or you know you have a kid that's gonna turn 18 soon or in the next couple years, show them this video before you take any job, right? Make sure they understand the tax deduction. Before you take any job, let me hook you up with a little thing. If you are going through a career change, understand these tax deductions. But let me show you something. I got some for you right here, right? So check this out, guys. I wish they had this when I was in high school. I graduated in 1998, Fullerton, Indians. Whatever you go to career day now, or before you take a job, or you know how much they're gonna pay, you can bust it in here. Let's say 100 grand a year. Newport Beach, single or married? Single, advanced. I'm married, by the way, but this is just if I graduated college or if I'm gonna take a job, I'll probably be single right now, right? Single, but I am married, happily married. I love my wife. Norma, love you, baby girl. All right. 401k contribution, if you want to add that. If you go above line of itemization, but we need just a standard deduction here, okay? Standard deduction. Exempt, just me, okay? You can hit the number, boom, boom, boom. I'll tell you how much you're gonna take home, 71 grand. Then can you take that job? Can you live off of 71 grand? Of course, if you're in Nevada, Texas, or Florida, you don't pay state income tax, so you get back a little bit more, but this will show you the income you're gonna have. So you know exactly what you're working with when you take a job to see what debts or what bills or how you can live your life. I wish they taught us this, but they didn't. But now you know, if you are gonna go through a job transition, look up smartasset.com. I'm not sponsored by them, but you guys, Smart Asset, if you're watching this, you want to cut me a check, cut me that check. That's how you can look up before you take a job, before your kids take a job. But that's how you figure out how much you can net so you can start budgeting, okay? We went over standard deductions, line itemization, how mortgages will help get you from standard to line. But of course, you need a lot of interest. So at the end of the year, you get that 1098. Also, we talked about if you're a new homeowner in 2021, what to make sure you have. You have that final HUD. Bring it into your tax preparer or your CPA. Make sure you maximize. Remember, let's push it to line itemization. That's the main reason of having a mortgage. If it doesn't, you're chasing appreciation or locking in a fixed payment. And for those who are self-employed, let me teach you guys a secret. The tax code was built to benefit investors, business owners first. Sole proprietary, wage earners, not so much. That's why if you're a wage earner, you need to max out, I'm not giving you tax advice, but I'm just giving you information. On your 401k, you can put 20 grand a year in it. I would max it out. If you need money in the future, you can borrow against it. At least get that deduction now. Okay? Invest it. Let your money compound. Don't let it sit in the bank because you don't want to max out your 401k. Max out your 401k. Max out your mortgage interest. Get that line itemization in there, fam, all right? Get yourself into that lower tax bracket. Keep your money without paying tax on that money. But if you're self-employed, you can write off your home. You don't write it off part of your line itemization, but is your self-employed income, you can write it off, okay? So you can do something called simplified option or regular method. So simplified option, hopefully the room is 300 square foot or larger, $5 a square foot, so that's $1,500 you can deduct from your income if you do simplified option. Regular method, you got to balance out all the percentages. Talk to your tax person about it. This is for self-employed. If you are a wage earner, a lot of you guys are working at home in 2020 and 2021. Guess what? There's no deduction for wage earners for a home. This is for self-employed. Find a way, once you buy a home, whatever occupation you're in, if there's a way for you to get paid to your LLC or your corporation, definitely do that. You can increase your deductions. Remember, when you're self-employed, you get taxed on your net, not your gross. As a wage earner, you get taxed on your gross. All right, guys? So if you are already self-employed, good for you. You probably know what to do. But if you are a wage earner and now you own a house, find a way to anchor your way you get paid as a self-employed person. If you can find a way to it. Who cares? Oh, I'm going to lose my health benefits. I'm telling you, your deductions will be greater as a self-employed person than a wage earner, okay? And so those of you who are self-employed, another rule that's solid, the Augusta Rule. It sounds like a Roman, Roman dictator. The Augusta Rule. So this is how the Augusta Rule works. If you own your business, not sole proprietor, like I said, most of the tax code is for investors and business owners. You can write off 14 days. You can pay yourself. You can pay, let's say you're the landlord, which is you own the house. You are your business, your LLC or your corp. You can rent space in your house to do meetings for 14 days. Let's say it's $1,000 a day. So for 14 days, that's $14,000. These are just numbers. $14,000 that you can deduct from your business income, and you can pay it to yourself. And guess what? You don't have to pay taxes on that money or report it to the IRS. So that 14 grand, you get to pocket without any IRS whopping their hand on it, waxing you with any taxes, all right? The Augusta Rule. So if you decide to go self-employed, you have this Augusta Rule. You have to own a home, though. I think you can do it on your apartment as well, but it's easier to justify on a home. So the Augusta Rule. So we talked about standard deductions, how mortgages help your deductions. We talked about if you bought a home in 2021, how to maximize your deduction to get into line itemization. We talk about self-employed. You can write off a portion of your house. You can do simplified or regular method. We talked about the Augusta Rule. And then last but not least, for those of you who are going to convert your property into an investment or you're buying investment property, you have so many deductions. What did the tax code teach you? I taught you guys. It helps business owners and investors. How the rich get richer, they just know the tax code. Investors, it's your accounts receivable minus your advertising, auto and lease, cleaning and maintenance, commission, insurance, legal, maintenance fees, mortgage interest, others, repair, supplies, taxes, utilities. So all of those are tax deductions. Accounts receivable minus your deductions. But I didn't say anything about line 18. 18 is free money, depreciation. So let's say you receive 20 grand after your deductions, you have 10 grand cash in hand. Typically that 10 grand, you're gonna have to pay tax on it. You had to pay to get advertising. So your 20 grand got deducted, right? Things deduct. But depreciation is free money. That doesn't come out of pocket. So you can depreciate. So let's say you can't depreciate a primary resident, but you can depreciate an investment. The property depreciates. So say with that, depreciation. They give you credits for it. So when you buy an investment property or you convert your property into investment property or you buy a commercial building, there's three main deductions. You cannot depreciate the land. The IRS is smart. They know land is not tax deductible, but the building depreciates. And most people deduct the building only. They're lazy or they just didn't know. They go with the standard deductions. So if you receive money, you want to maximize your deduction. You want to take your rent money out tax-free. But if you go with the standard one, you might not hit the limit. But if you deduct what's inside the building, you have any appliances, washer, dryer, you have oven, you have microwave, refrigerator. When you buy an investment or you buy a commercial, leave everything, player. Leave everything. I'll pay you a little extra. Leave everything. All of that you can amortize, which means you're adding more credits. So you wipe it out. And you deduct over the limit of what your cash flow is, you can carry on for the next year. Also, you deduct landscaping. That fence, they have a fence, you can deduct that. And those have greater deductions than the actual structure. The structure, I think it's 27.5 years, depending on what other deductions are, but you can increase those. So if you buy an investment property or you're going to convert your property to an investment or you're buying a building, you might want to look into something called a chateau appraisal or a segregation report. You want to be able to increase line 18. You want to go YOLO on that thing. Of course, if you sell it, you might have to do some clawbacks, but that's another day, another story. But you want to maximize your cash flow. So if you own property, you buy property, you want to look into how to increase your depreciation. And check this out, with depreciation, when you go qualified to buy another property, it's added back as income. Woo! It doesn't just help you deduct, but it adds back as income. How crazy is that for you to qualify to buy another investment? Remember, the tax code is there to protect business owners, investors. If you're a wage earner or sole proprietor, you want to maximize your mortgage interest for that deduction, all right? Hopefully that was useful information. So the goal, if you do have a mortgage or you're going to get a mortgage, is to drive down your income. You're going to make the money, but you want to drive down your income with deductions on your personal business to maximize your tax benefit. Hopefully this information was useful. If it was, guys, do me a huge favor. Please like and share, all right? Tag someone who just bought a home, please. Tag someone who's going to buy a home in 2022. PMI might not be tax deductible in 2022. And also, please verify all this information with your CPA, your tax person. Don't be running to people saying, oh, Minh taught me this. I'm just telling you what I read in the IRS book. I am not a tax person. I'm not a lawyer. I'm just here to share with you what I read on irs.gov. Do me a huge favor, guys. If you're not following us on TikTok and YouTube yet, please go ahead and do so. We're trying to grow our audience, all right? It would help us out tremendously. And we want to end all our episodes with our attitude is gratitude. Without you guys, there'd be no us. So thank you guys so much and have a great night.